Good day, everyone. I'm Lauren Maxey here with attorney Kyle Frizzell, back again for another tax talk. Today, we're going to be focusing on some of the wonderful solutions. So as you may recall, we previously did a video centered around the proposed tax amendments for the Biden administration. A lot of changes. So if you haven't seen that video, go back, check it out. We're going to be referencing a little bit of that today, but again, in our day-to-day world, a lot of our emphasis is going to be on the estate planning side of things, the estate tax implications of these potential changes. But to go back and just kind of touch on a little bit of background and why we care, why this is so important, and why we're going to be discussing it a lot with our clients is essentially, as many of you may recall, back it was actually enacted December 22nd, 2017, was the Tax Cut and Jobs Act, became effective in 2018. But that changed our estate tax landscape dramatically. So it increased our individual exemption amounts to $11,580,000 per individual. Doing the math, that's $23,160,000 per marital couple that they could give away during life or at passing without incurring a gift or estate tax. So up until this point, many of our clients don't have those problems. It's not a big concern. However, with the Biden proposals that may come through, essentially that very well could drop dramatically. So to back up, it's naturally going to drop in 2026, January 1, 2026, down to $5 million per individual if Congress does not take any action. If things happen and both of those seats that are up for re-election in Georgia go blue, there is a large potential that these estate tax proposals could become law. And what Biden is talking about right now and has proposed is reducing it to $3.5 million per individual. So as you can imagine, that affects a lot more of our clients, and individuals need to be concerned about this and locking in certain things. So we're going to talk about some of the tools in the toolbox of how to minimize on those estate tax exposure concerns. Again, if things come through, the exemption amount down to 3.5 million and the tax rate, if you go over that, could be 45% to 65%. We're not certain where it's going to lie, but it's going to be a big chunk. So again, that's just a little background with the Tax Cut and Jobs Act of what we're looking back. The other thing I want you to keep in mind of when we're talking about some of these strategies, there is what's called anti-clawback rules. And so if you're doing planning under the current scheme of things, under the Tax Cut and Jobs Act regulations, and you are planning and utilizing some of that 23.16 million or 11.58 million per individual, essentially they're not allowed to ding you if you pass at a later year and things have come back down, as long as when you did it, you had that exemption amount. So it's kind of a use it or lose it type item. But again, that's just a little bit of background of what we're looking at. Kyle's going to touch on a few additional items here, and we're going to just launch right into kind of some of these strategic planning tools that we're going to be looking at with our clients.
All right. Well, thanks, Lauren. Yeah, guys, a lot of this is going to come down to good old-fashioned proactive planning. Lauren just touched on a bunch of the tax changes that we're potentially looking at, but that last thing that she mentioned, the anti-clawback rule, that's going to put the importance or stress the importance of proactive planning even more, because before these tax changes are implemented, we do have a little bit of time where we can potentially put some plans in place that lock in this higher exemption amount on the estate tax side. So these are things that we definitely want to take a look at. And if these are concerns for you, given where the proposal lies to drop these estate tax exemptions somewhere between 3.5 and 5 million. Um, no time like the present to at least consider making some changes there. And one of the other big changes that we're looking at is this. We touched on it in our last video, but this change to the way basis adjusts when somebody passes away. Currently, when somebody passes away, we get what's called a step up in basis, meaning that somebody can sell an asset shortly thereafter for usually very little or no gain, and that results in no capital gains, um, not paying tax on that amount. Under the Biden proposal, what we're actually looking at is the potential for that step up in basis to go away and having something called carryover basis, which is the way that it looks like things are going. Um, Carryover basis would be basically you inherit the basis that the previous owner had. It works kind of the same way that a gift during life does right now. So we think that they're going to get treated pretty similarly. Again, this is all going to hinge on what happens in the great state of Georgia. But these are tax changes that have been talked about for a long time. And so even if they don't happen this time around, just depending on which way the winds in Washington, D.C. blow, we could see these changes really at any point. So it's always, you always want to have these in the back of your mind. So that threat to the income tax basis adjustment is going to be a big deal. So proactive planning, also a big deal. Want to make sure that we potentially lock in some of these benefits under current law that we have now. Lauren mentioned that this is kind of a use it or lose it scenario, and that's what we want to do. If we've got 11.5 million, call it that right now, and we're looking at dropping that amount down to 3.5 million, that's just giving away or giving up $8 million worth of tax benefit that we don't have to. So as Lauren said, what we want to do today is talk about some strategies that we could put into place now or potentially later to help deal with this estate tax, gift tax issue. So I know Lauren's going to start us off by touching on notes and sales among family members. We've got a couple others that we're going to talk about after that. We've got the alphabet soup, if you will, of trust that we will touch on. Idgits, grats, slats, islets, more on that to come. But a whole lot of tools in the toolbox, but what actually makes sense for you is going to depend on your own personal goals, and we'll touch on those as well. But I'll turn it back over to Lauren now. I think she's going to start us off with family notes and sales.
Yeah, and I'll just echo that sentiment, Kyle. There are a lot of tools in the toolbox, a lot of initials we're going to throw at you. And what we're passionate about, as Kyle touched on, is finding the right one for our clients, their goals, their wishes, their concerns. This is not a one-size-fits-all type planning. It's very individualistic around, again, what's your asset picture? What's your exposure? What can we do to maximize on things? So first up, we're going to touch on family notes and sales. This is kind of relatively, in as we're looking at more complex trust structures, this is kind of a simplistic planning tool of a family note. And it's just as it sounds, you're loaning money to a family member. Usually it's a parent loaning to a child in a lower tax bracket, loaning money, and you have a promissory note. Of course, you want to paper it up and have it memorialized. There does have to be an interest rate associated with the promissory note, valid terms and all of that. But typically the interest rate that we're looking at for these family notes is just the applicable federal rate, whatever that is at that point in time, which most commonly, especially in today's interest rate environment, is lower than the rate of return that we would expect if you were investing that property. So what that means is essentially you're transferring money to a child or whoever. They're paying you the interest back for that and paying you the principal back, of course. But the gain on that property, whatever above the interest rate and the actual return on investment, is out of your estate. This does not use any of your lifetime exemption amount, so it's kind of an easy tool to implement because you are getting that principal and interest back. all good. So that's basically what you're looking at for the family note. What you're loaning and all of that is again, we can touch base on that depending on your individual picture. A family sale is a very similar strategy. Very commonly, we're selling an income producing piece of property. Very commonly, we're looking at rental property or something like that. But you're selling that, and it is an arm's length transaction, selling it to another individual, very oftentimes parent to a child. And then the income that's generated from that piece of property is taxed at the child's lower income tax rate, presumably, rather than the parent that's in a higher bracket, very commonly. And again, similar to the family note, they're paying back that applicable federal rate. There's a note associated with that sale, but it's the double whammy of getting the rate of return on that property, the return on investment out of your estate, as well as the income out of your estate. So that's a nice tool in the toolbox to be aware of as well. And so, yeah, it's, again, looking at your individual asset picture, what's most appropriate there, but that's an easy step one. We've got, as things get more complex, and Kyle's going to touch on an IDGIT in a moment, the opportunity for saving increases as well. So I'll turn it over to you, Kyle.
All right. Yeah. So Lauren touched on family notes and sales, and that's, like she said, a little bit of a simplistic approach to dealing with this estate tax issue. To layer something a little bit more complicated, I guess, on top of it, is our first of the alphabet soup when it comes to trust. And this is actually a really neat planning tool. It's called an IDGIT, which stands for an intentionally defective grantor trust. And I always get the question, well, what is it defective for? What does that even mean? And really the defective piece of this, if you will, and it's not defective at all, is that the trust itself gets treated, you as the grantor and the trust are treated the same for federal income tax purposes. What that means is that as that trust is generating income, that income is going to get taxed to you personally, which is, that may not sound like a benefit, but when you look at the tax brackets for trust, it actually is a very large benefit. So what happens here with an IDGIT, the first way that we use these is through using what's called an installment sale, where we sell assets to the trust and the trust pays you back. And that creates that arm's length transaction, similar to what Lauren was talking about, but instead of it being between you and a family member, this time it's between you and a trust. So assets essentially under this structure get sold to the trust. The trust is seeded with usually about a 10 to 15% gift, if you will, which is based on the value of the assets that are being sold to the trust. That note is paid back to you. You're taxed on that income. But any of the appreciation that is occurring within that trust is going to ultimately pass to your beneficiaries, whether that be other family members, some portion of it maybe back to yourself at some point. Essentially, they're going to pass gift and estate tax free. If it's not you, it's to another family member beneficiary. The interest payments on that note, again, are not going to be taxable to you because you're treated as the owner of the IDGIT's assets. That's the defective piece of it. And then what happens here is the capital gains, they're not going to be recognized when the assets are sold to the IDGIT because, again, this defectiveness is that you're treated as selling the assets to yourself. So this is actually a really neat tool. And I know that may sound really complicated, but what we're doing here is you're gifting a seed asset to the trust. You are then selling an asset to the trust. That seed money is what starts paying you back. Usually you're going to set up this installment note with a relatively low interest rate. and it's based on the fair market value of the asset that gets sold to the IDGIT. So money and property goes into the IDGIT, you're getting paid back. Ultimately, if something happens to you, or at the end of that installment note, the appreciation from that IDGIT, or that occurred within the IDGIT, is going to pass to you. And you're going to see on your screen, there's a little bit of a diagram here that explains that perhaps better than I do in words. But overall, big picture here, the income tax piece of this is to you. You're getting taxed on the income piece, which is a benefit, but the appreciation is going to pass estate and gift tax free to your beneficiaries. And so that's part one when it comes to an IDGIT. Now we get to layer even more on top of that. And I'm going to start talking a little bit about what's called a swap power. So swap powers layer on top of an IDGIT really well. Basically, one of the things that I'll say about estate planning or estate tax planning is there's some complicated things that go on, but when you hear a thing like swap power, it literally means that we are swapping assets. So at least we give them good names. But this is a swap power for basis management. What happens is you're going to gift assets during your lifetime, or assets that are gifted during your lifetime that ordinarily don't receive a step up in basis when you pass away. By exchanging through use of an IDGIT, a high basis asset for a low basis asset through this swap power, it's included in the language of a trust, you can lower the income tax piece that we were dealing with before, and the asset will receive a basis adjustment when you pass away, assuming that the law there doesn't change. So a lot of this is going to depend on what does happen in Washington, D.C., but at least currently, we can include a swap power within something like an IDGIT. You can swap a high basis asset for a low basis asset. That's going to result in not having a gift tax consequence, not having that gain recognized. And then there is the goal is that if we set this up properly, there's either no or a limited inclusion of the asset that you're moving into this trust in your gross estate. There's a whole lot of IRS code sections that we have to be aware of here. But you can really move pretty much all kinds of assets into this type of a structure. Assets that you might ordinarily have a loss on. You can move life insurance as long as we're careful about how we're transferring that life insurance policy and it is a fair market value transaction. You can even move your house or other property into some structure like this. Again, this swap power allowing you to swap some high basis asset for a low basis asset so that the low basis asset basically comes up to a new higher basis when you pass away. This, again, it gets kind of in the weeds, but that's kind of our big picture there. Hopefully the diagram that's on your screen will make a little bit more sense. In this picture that you see, you're going to see that there is basically an asset that is worth $1 million, but with a $200,000 basis that was currently in this irrevocable trust structure. You also have an asset individually that is worth $1 million, but has $1.5 million basis. So that asset actually holds a loss. What we want to do here is we want to swap those two assets. So you're taking the low basis asset from the trust, you're replacing it with a high basis asset, and that $500,000 loss in this example basically gets carried forward to subsequent years. The remainder is going to pass to your beneficiaries. That trust goes away. And so again, our goal here is to receive a step up in basis in that lower basis asset, which is then going to pass to your beneficiaries under current law with that step up in basis. And so, again, lots going on here, lots of alphabet soup, lots of swap powers and things like that. Um, but we'll keep things rolling right along here. I think Lauren's going to talk about our next trust, the Grantor Retained Annuity Trust.
Yes, the GRAT. And swap powers actually relay very nicely into the GRAT as well, and we'll touch on that in a second. But just as it sounds, Grantor Retained Annuity. This is another option, a tool in the toolbox where the grantor transfers assets to the trust, but retains an annuity stream, the right to an annuity back from that trust for the principal and the interest. And so essentially that transfer gift to the trust is not really a gift. It's essentially kind of, if you want to think of it like a loan, but the grantor is retaining that annuity and receiving all of those assets plus interest back. And it's usually for a specified term. Usually we look around 3 years or something like that, but getting all of that back, the beauty of that is it's not eating up your lifetime exemption amount is why this is a nice piece. And again, the theory of all this being the growth that's achieved in the market or what have you, how those properties are invested within the grantor retained annuity passes to your beneficiaries, most often to the kids, estate tax implication free. So that's a very nice piece. Where the swap power, again, layering things together, adds a little complexity, but potential for a great benefit is, say you put some stock into this grantor retained annuity, and the stock appreciates greatly in value. You're only receiving that small interest rate back, but the stock has done fantastic, ideally. You can then swap cash for that stock, and basically lock in the gain to your beneficiaries. So that's a very nice tool in the toolbox. Again, getting a little creative with some of this, but very effective way of playing with it. So looking at that diagram again, some of us are visual learners, but essentially you're transferring the assets into the GRAT, receiving that annuity back for that term of years, but all of the essential gain above the interest goes to your beneficiaries. Happy faces there. So similar, we're going to touch base on a SLAT. So we talked about GRAT, SLAT, S-L-A-T, Spousal Lifetime Access Trust. Now, this is something that's pretty cool. And if things go Democratic in Georgia, this is something we very well may see a lot of for spousal couples that have estate tax concerns. Because essentially what you're doing is you're gifting your assets to your spouse in trust, and very oftentimes the kids are remainder beneficiaries or what have you. It is an irrevocable trust set up for your spouse. And again, as we talked based on the anti-clawback rules, you can gift your entire estate over there. That is utilizing the exemption that we have right now, but it's kind of locking it in for your spouse. And so gain, anything after that is outside of your estate, and you're utilizing, say you've got a $10 million estate. You're locking in your $5 million going to your spouse under the current estate and tax laws. That's not exceeding your exemption. That's all estate and gift tax free. Whereas if things change and you were to do that at your passing years in the future, it could be exposed to estate tax. So you get it over to your spouse. You do have to have an independent trustee. So your spouse can't be trustee over their trust. You can't be trustee over their trust, but ideally a friendly, independent trustee. And the logic being your spouse still has access to these funds, so you can get some tangential benefit. Additionally, very commonly, we're doing kind of trust for each spouse. So you do it for your spouse does it for you. You do want to be very careful. And again, the devil's in the detail with this stuff. So working with someone that this is what they do all day long. Because if they are just mirror images of one another, it can cancel out the entire benefit, and IRS will see them as reciprocal trust. So they need to be structured properly. But again, a very potentially hugely beneficial tool. Looking at what we're looking at, being able to lock in your entire exemption amount for your spouse. This is huge. So again, summary with the diagram here. You fund the trust with your property. At your passing, all of the assets are distributed to your beneficiaries, and it's the exemption amount that's being considered is the exemption amount that was in place upon the funding of the trust, not at your passing. So it's, again, a nice little structure there to play with. Let's see here. And next up, we are looking at a charitable lead annuity trust, a CLAT. Kyle, do you want to take us away on this one?
I can. And so again, more letters that we're throwing at you, but
Yeah.
this time we're talking about charities. And so just to kind of recap, Lauren briefly touched on the Grantor Retained Annuity Trust, the GRAT. That's where you, as the grantor, retain some sort of a benefit for a period of time. We just talked about the SLAT, the Spousal Lifetime Access Trust, where that benefit during life is going to be with the spouse. This one, kind of in that same vein, we're trying to determine who's getting the lifetime benefit of a trust. In this case, it's going to be a charity. So for those clients who are charitably inclined, this is a tremendous tool. And so something that we've done in the past, if you looked at trust before, you may have seen more charitable remainder trust. Well, right now with interest rates where they are, and our overall goal and the goal of a lot of our clients is to have some sort of wealth transfer to their family. It's not that they're not charitably inclined at all. It's just that they would like for the bulk of their assets to transfer within their family, and then there be some sort of a charitable benefit as well. So enter the charitable lead annuity trust. Again, kind of going back to what we talked about earlier, we name these things so that they explain themselves. Charitable lead, meaning a charity is getting money first. The annuity piece means that we are determining the payment early on when we set up the trust. And of course, it's a trust. So charitable lead annuity trust, or a CLAT. This is a very similar structure to what Lauren talked about, the Grantor Retained Annuity Trust. But those annuity payments, they're going to go to one or more charities rather than back to you. So this is going to, again, it's letting you take advantage of low interest rates. We're able to, in the long run, so big picture is we are passing the appreciation of the assets in this trust to our beneficiaries free of gift and estate tax. The trust, we always like to try and structure it to qualify for both income and gift tax charitable deductions. So there's a little bit more tax saving potential here because of the charitable deduction that we do not get under a GRAT or a SLAT scenario. And there are some neat things you can do here, especially for higher net worth clients. A lot of those clients can create, or some have created, family foundations, and their family foundation, where they've tried to create a legacy of giving, can actually be the beneficiary of a trust like this. And so what we're trying to do here is maximize the during life tax savings by having some sort of a charitable deduction on an income tax side of things, but also when after the charity has received their annuity for the specified amount of time that you've set up early on. And that's based on interest rates, and people who run numbers a whole lot better than me are going to run those numbers. We always want to work with a good CPA. But they determine the actuarial value of what the charity is going to receive. There is the income tax benefit. And then whatever's left over, as long as we've set it up properly and canceled out the amount of gifts with these deductions that we're going to take, whatever's left over and the appreciation of whatever's left over is going to pass back to your family. So most often it's children who are the beneficiaries here. And those trust terms from that point they really become whatever we want them to be. So setting it up the same way you might have set up other trusts, where it's a payout over time. Maybe they're not going to get this lump sum. Really very flexible tool here. One thing that I'll note here, and one thing that we always have to be cautious of, and just because I happen to mention the family foundation piece of this, if you as the grantor have created a family foundation and you're an officer or director of the foundation and have tremendous decision-making authority over that foundation. So there's got to be a good corporate structure in place. What happens if you have too much control? The IRS may look at that and say that there's no real difference between that charity and you individually. And they can say all or at least a portion of this charitable lead annuity trust is going to be included in your gross estate, and all that great planning that we thought we did, quite frankly, becomes all for naught. So if you have a family foundation or decide to create one, it's very important to have this structured properly. If it's a third-party charity, we're really not worried about that. The concern is more in the trust setup. So to show you a little bit about what this looks like, there is the diagram on your screen. Basically what happens here, we are moving money or property over into the trust. So in this example, we're assuming there's $10 million worth of assets. So as you can see, this is a high net worth planning tool most often. And we've determined in this example that it's going to be a 20-year term with a 0.8% interest rate, which right now you can get away with because these are historically low interest rates. So that means that the charity's getting something. I mean, 0.8% of $10 million over 20 years is still really good, and the charity is going to be really happy to get it. But when that initial term is over, the remainder is either coming back to you or it's coming to other non-charitable beneficiaries, so your kids in that case. And assuming we've had this return on investment that we've had over the last few years, where the stock market has done really well and interest rates still remain so low, in this example, we've assumed a 5 to 6% return on investment. That makes it that $10 million that you initially transferred, you've given to charity, and yet still your beneficiaries or yourself are receiving back $16 million. So $6 million worth of gain that is estate and gift tax free, as long as we set things up properly. During that time, that annuity payment that went to charity was roughly an $11 million gift. And so depending on how it was set up, the charity's been receiving that money as a set amount or a fixed percentage of the trust. So again, if we just rough that in and say $11 million, that is a charitable deduction that the trust gets to take in that case. So an incredible planning tool here. It does lend itself a little bit more towards high net worth individuals, but if this estate tax law changes, and we are looking at more like a $3.5 million exemption, this might make sense for more people. So it's something that we wanted to share with you today. And so the next piece of this, I'll turn it back over to Lauren. This is probably one of the most, I guess, pre-2010, it was a very common estate planning tool. It will likely work its way back into common use. And so this one, out of everything that we've talked about, at least when it comes to a trust structure, may make the most sense for a lot of people. And so Lauren, I'll turn it back over to you to talk about pilots.
Yeah, happy to do so. And you're exactly right. This is probably the most familiar of what we've discussed. And so the Irrevocable Life Insurance Trust, the ILIT, again, very commonly used in the past, got away from it when estate tax laws changed and they weren't as big a concern, but we do anticipate this to kind of work its way back in. Same as the rest of the planning tools that may have previously been for more uber high net worth individuals. Now we're looking at individuals with family businesses, individuals with a bunch of land or something like that. And so sitting down, talking about what is your asset picture, what are these concerns, but the eyelet, very simply, is a nice tool to have some liquidity at your passing, and have that liquidity be estate tax free. So what we're looking at here is, again, irrevocable trust, as the eyelet denotes, where the life insurance, as Kyle was touching on, those names kind of clue you into what we're dealing with here. But you take a life insurance policy. Most often it's upon purchase of the life insurance policy or what have you, but you could theoretically use a policy that's in existence. You transfer that into the trust, or you just have the trust purchase it within the trust to start. But say you have an old life insurance policy, whatever cash value that has accrued in that policy is what you're kind of gifting over to the trust. So most commonly, though, we're purchasing a new policy in the trust, and those annual premium payments are essentially gifts that you're making to that trust. The nice piece is you get to kind of take advantage of your annual exclusion amount. So reducing how much of that gift is taking away of your lifetime exemption amount. But you're making those annual gifts, you're making those payments to that irrevocable life insurance trust. There are some quirks with the eyelets of essentially needing to have what's called crummy letters. That's relating to an old case that I'm not going to bore you with. But it's essentially the beneficiary signing off and saying, hey, I acknowledge that this gift has been made to the trust and I have the right to remove it. I'm not going to do that. I want to leave it in the trust. So again, it's more of making sure everyone knows these annual kind of certifications need to be in place. The whole point of this, though, is that the benefit, the death benefit, upon your passing, again, typically the life insurance policy is on the life of the grantor. The benefit upon your passing is outside of your estate. So the example that I shared earlier, if we have a bunch of family land that we don't necessarily want to sell, an eyelet is a great tool to consider, because if we're going to have some estate tax exposure and you're not comfortable with some of those more complex, potentially advantageous structures, an eyelet is kind of a Band-Aid, if you want to think of it. It just gets us some liquidity outside of the estate to pay off estate taxes or what have you without having to sell the farm or what have you. So that's kind of an interesting tool. It can also serve to just reduce your overall estate tax exemption amount. So looking at these diagrams here, the first diagram is just showing if the insurance was distributed upon the husband's passing directly outright to the wife. They also had a family trust in place where some of his assets went into the family trust. But under this first scenario, if that $5 million life insurance policy just goes outright to his spouse, then upon her passing, it's eating up her exemption amount as well. And so it's a little bit of a snowball effect, but you're looking at $2 million in taxes that are due under this scenario. Whereas if you were to implement a eyelet and the husband were to pass that life insurance policy to his spouse in trust, and again, upon her passing, it's not eating up her lifetime exemption amount as well, 0 in taxes due. So again, not a one-size-fits-all thing, but a very beneficial tool. A lot of people are more comfortable with this tool because it's a little more simplistic. Again, as Kyle touched on earlier, we're not doing any of this planning without talking with your CPA and very commonly your financial advisor, having everyone on the same page of what we're looking at and what's best for you from a holistic planning perspective. But this is a very common tool to play with. And I think openly some of the other planning tools can be much more beneficial, but it's what you're comfortable with. Our whole role is to advise on what are the tools in the toolbox, what can we do for you, and then you can make the educated decision from there. So Kyle, if you want to touch on next steps and what people should be thinking about.
Yeah, absolutely. And next steps, guys, really is to start thinking about this and start having conversations with your advisors. So whether it be financial advisor, CPA, or your attorney, these are things that if you are concerned, if you have a sizable estate and these changes that under the Biden tax proposal look like they're going to have an impact on you, even if it may have a very minor impact, it's something you will want to discuss with your advisory team. Um, those folks, they're going to be able to shed a little bit more light on what the implications might be. I know with our clients, these are conversations that have started. I think for now it's kind of the, is this going to happen, what changes, what is the potential changes, or what are they?
Mhm.
um, Pretty soon, depending on what happens in Georgia, and just depending on how the next few years go, quite frankly, these changes may come to light. And so the more you think about it now, um, at least the current trajectory is that the estate tax exemption amount probably isn't going to get much higher than it currently is under the current, um, current setup under the Tax Cuts and Jobs Act. Um, in one sense, it's kind of a why not lock some of this in now while we can.
Mhm.
There's always the chance that maybe some of this stuff gets repealed later under a different administration many years down the road, or maybe these exemption amounts get even higher. But at least in the shorter term, I don't know that they're going to get much higher than they are now. I mean, the inflation adjustments will continue to occur, but while we're able to put some of these planning tools in place, we should be looking at them. And so for us, it's having that strategic planning conversation with our clients. So for those of you who have questions, feel free to reach out. It just kind of starts with a conversation. We're going to lay out, look at current financial picture, and we'll start looking at some of these tools and see what makes sense. And we're going to talk through your goals. Are you charitably inclined? Does this charitable lead trust make sense? Do you really like having income yourself
Yeah.
from your assets? Because if so, that grantor retained annuity trust might make more sense. So it's it's a calculated approach to this, if you will, but it all starts with that conversation. So uh, the team here at NC Planning more than ready to have that conversation with you. So feel free to reach out, um, but get the conversation started. I think that's the biggest next step that you have.
100%. And that's exactly it. We're ready to hit the ground running with this. We know it's incredibly important for our clients. So if you have concerns, give us a call. We're happy to touch base. You should be having those open communications with your advisory team. So we'll leave it there. Hope y'all have a lovely beginning to your 2021. And we'll take it one piece at a time. Y'all have a good day.